It's a pleasure to have you on Business Incorporated. I am Bisi Adebayo. Coming up today, UK economy rebounds in the second quarter of 2018 after a weak start to the year. And emerging market currencies slip on escalating global trade tensions. And Tunisia reports a 42% increase in tourism revenue between January and July 2018. Well, let's begin today's show with the latest data from the UK's Office for National Statistics, showing the country's economy rebounded in the second quarter after a weak start to the year. The gross domestic product grew by 0.4% between April and June, compared to 0.2% in the first 3 months of 2018. The head of national accounts at the ONS, Rob Kent-Smith, says the economy picked up a little in the second quarter, with both retail sales and construction helped by the good weather and rebounding from the effects of the snow earlier in the year. He, however, pointed out that the country's manufacturing continued to fall back from its high point recorded at the end of 2017, while underlying growth remains modest by historical standards. Now let's review intraday numbers from the stock markets, and here in Nigeria, the all-share index is taking a massive haircut at noon with a 1.99% decline. The South African index was 0.12% lower, while in Egypt it closed up at 0.56% on Thursday. The Kenyan Bourse also finished Thursday's session in positive territory. And the markets in the Middle East are closed for the week, but all the major indices ended mostly lower as volatile oil prices hit petrochemical and energy firms in the Saudi market, while lower than expected earnings of property firm Adler Properties weighed on the Abu Dhabi market. Abu Dhabi slipped 1.09%, easing from a near 4-year high on Wednesday. In neighboring Dubai, the index dropped almost 1% on selling in lender Emirates NBD, which declined 2.9%. Well, Saudi stocks were down 0.4% as sharp swings in oil prices hit sentiment. The Qatari index fell almost 0.8%, dragged down by Industries Qatar, which fell 2.3% despite reporting a rise in first-half profits. And in Europe, the stocks opened lower this morning as investors reacted to corporate earnings, fresh turmoil for Turkey, and continued fears of a trade war between the US and China. But let's get more on today's market performance from Conrad Busin at the Frankfurt Stock Exchange. Conrad, so the US dollar index is jumping higher on other major currencies, thrashing Turkish lira some 12%. Should the ECB be worried about the Turkish contagion?
Yes, it should be, C. And maybe I remind our viewers first that, of course, Turkey is not a member neither of the European Union nor of the Eurozone, which is the currency union. But, of course, there are strong connections between Turkey and the Eurozone. The concerns are now that European banks might be drawn into the Turkish crisis, as many of those loans which have been driving the boom in the Turkish economy in recent years were given out by European banks. For example, banks from Spain, Italy and France have given out loans worth up to 135 billion euros to Turkish business in recent years. Now, of course, there is the concern that with the strong depreciation of the Turkish lira, the businesses in Turkey and consumers will find it difficult to pay back those loans. That's why the European Central Bank, as the major supervisors of the banks in the Eurozone, is concerned. People at the ECB here in Frankfurt are on high alert. Now, what the scenarios are, I can tell you that people are discussing at the moment. Capital controls are a possibility if the depreciation of the Turkish lira continues. Capital controls, maybe even the IMF, the International Monetary Fund, might have to step in Turkey. But given the rather patriotic or nationalist tone of the Turkish president, Recep Tayyip Erdogan, it's unlikely that the government in Ankara is ready to cooperate with the IMF, and that, of course, escalates the concerns about the country.
Now, Conrad, let's talk about the UK GDP numbers now. We'll see a rise, a 0.45% rise in the second quarter. And of course, that meets expectations with the construction output higher, nearly 1%. Is this good news for the Brexiteers or the stay advocates?
BC, as always, it's quite probable that both sides will tweak the numbers so they can fit their argument. It's very dangerous to talk about this topic at the moment because either side will tell you that you are biased against it. But let me tell you what the economists told me, who I managed to talk to here, and the reports of economists say, at least in terms of the majority of reports that I managed to read. Yes, the quarterly growth numbers of the UK economy came in stronger than what most economists had predicted, which is, of course, good news for the economy. But there are a few reasons why the growth in the second quarter was stronger. Reason number one is that the first quarter in the UK's economy was so weak. Remember how we talked about the beast from the east, the strong winter winds, the strong cold this winter in the UK, which halted the economy there, of course, namely building, home construction was very weak in the first quarter. And there was, of course, a rebound during the months of April through June in construction in the UK. What's more, the UK saw during the second quarter a royal wedding and a much better than anticipated Football World Cup. And both contributed to a strong increase in the services sector in the UK. The Brits went, drinking and dining. They went shopping more than anticipated. And this is likely, those one-off effects are not likely to see an equivalent in the current quarter or in the coming quarters. What's more, of course, there is the constant danger and a growing threat of a no-deal Brexit. This is likely to weigh on sentiment further. So it's not very likely that we are going to see positive surprises like the one from the second quarter in the quarters to come.
And what are the main takeaways from this week of high-octane geopolitical tensions, trade spat, climate problems, earnings, and so many other things that have happened this week?
Yes, lots of doom and gloom covering the markets. The main takeaway, I would say, is that it's not enough for companies to simply come up with strong earnings. We've seen a couple of strong earnings reports coming in from European companies in the course of this week. Hannover Re, Adidas, Commerzbank, you name it. But the share prices not always manage to climb. The problem is that from the point of view of investors, they're not really sure what to expect in the coming quarters. Also, if we look in the United States, the average there is higher, the average on the stock market. But mostly, again, it was tech stocks, companies like Amazon, Google, Facebook, which managed to gain. The manufacturing sector, companies like General Electric, they are lagging behind. And if you look at the political picture, if you look at the geopolitical tensions, you named you named this as a negative driver, and of course we've been talking about Russia, America, the tensions there, the new sanctions. We've been talking about Saudi Arabia and Canada. It doesn't really look like cooperation is the word of the day and the word of those times. So this is not likely to inspire investors in the coming months further. Also, of course, we have always to keep in mind that interest rates are likely to rise further in the US, which makes bonds more attractive. So let's not be overconfident for stocks.
Well, we'll see how all that plays out in the coming days. Well, thank you, Conrad. It's been a great week with you, and you have a wonderful weekend.